I think it's going to be very much dependent on what happens in the jobs report and the inflation report over the next couple of weeks or so. And I know the Fed have said their data, not data point dependent, they're sort of looking at the whole matrix of data, but ultimately it does feel that we're coming down to a couple of points that are very interesting. Our base case is that they do still want to ease policy, but if we do get an oversized upside surprise in the jobs market, then I think it's really going to be called into question, because what we're seeing at the moment is the data has not deteriorated maybe to the extent the Fed was expecting. And when you look at where core PCE is expected to come out later this week, we're going to be above what they were predicting in their September projections, which ultimately again questions whether they actually need to cut rates.
I wonder whether you think that the September jumbo rate cut was actually a mistake, now that we know that Donald Trump is going to be the next president.
Well, they obviously didn't know that at the time, so it's very difficult to say that. I mean, you could say some people were saying, well, they should have cut in July because we obviously had that very weak jobs report following that, and they were just sort of catching up. I think ultimately what we've seen and what we've heard from the Federal Reserve is they think rates are restrictive. They think they've made very good headway on inflation. And as they've said, they're unwilling to let the jobs market weaken further from here. I think the question they're going to have a big debate about is, are we still seeing inflation heading in the right direction, or is it becoming a bit stickier, sort of in the mid-twos? And are we continuing to, or are they still expecting weakness in that jobs market, or actually always seeing some stability? Jerome Powell's told us they're not going to speculate on what policies and the sequencing and the timing of those. They have to look at the economic data here and now.
Right.
But it just does look a little bit better than maybe it was back in September.
I wonder as well whether the December meeting is actually more relevant, perhaps in terms of the commentary that we might get going into 2025, or whether it will be the rate decision that will be the key moment for the markets, because it seems that everyone is trying to understand what's going to happen in 2025 now that we know who's going to be the next president. So for you, when you hear from the Fed in December, what will be the key thing you'll be looking for?
I think we're going to get another set of economic projections. So it feels like they might take down their expectations for cuts for next year. So I think that's going to be very key. It'll also be very key to see what the expectations are from an unemployment rate, from an inflation standpoint, and then just getting a sense of in the Q&A as to what Powell is thinking about the economy. As I said, they're not likely to speculate. We don't know exactly how quickly these policies are going to come through. It will be interesting to see whether we get any pickup in sentiment. Obviously, we know financial conditions have eased off a bit with equities and credit spreads doing so well recently. Are we going to see that come through to some of the survey data? There's going to be a lot to digest from it, but it's going to be about how Powell thinks about the economy and how they're projecting for next year.
Naturally. We were mentioning, perhaps we can show it on the screen, how we're trading in terms of the 10-year Treasury yield. I've started to see some commentary suggesting that it could go up all the way to 5% now that we know that Donald Trump is going to be the next president. What I would like to understand is what sort of range do you predict the 10-year Treasury yield to be fluctuating over the coming months? And at what point could that actually spark some concern, that in terms of like what level would actually spark concern, basically?
Yeah, and I think it's a challenging one because there is a lot of uncertainty about exactly what's going to happen. So we would say somewhere between 4 to 5% over the shorter term seems reasonable. I think it's quite difficult to get much above 5. If you think where we were, this time or maybe a little bit earlier last year when we really got that spike up towards 5, we were at 5.5 on the Fed funds rate. The market was still expecting further hikes. The Fed had still another hike in their projections. We're in a very different world today, particularly if they do cut in December. So for us really to go through 5, you have to have a view that the Federal Reserve has made a mistake and they're going to be reversing and hiking quite quickly next year. I don't think that's base case. I think base case is that they are going to be paused here or taking rates lower over the shorter term. So our expectation is that they continue to go. That actually means that we're getting to a level where the bond market and yields are looking particularly interesting, I think.